there are probably three big themes this year. The first is that there's much more direct investment, so people don't necessarily want to go into a discretionary vehicle. If they have the expertise and they're committing a large amount of capital, they want to go direct. It's a lower fee model, and it allows people to move money faster. The second is there's a cycle out of the opportunity funds where people feel it's a little bit late in the cycle and it's harder to justify an environment where you can get 20% returns. Cycling out of those and cycling into open-ended core plus vehicles where the returns might not be as juicy, but the risks are perceived to be much lower and capital can be deployed for a much longer period of time. And then thirdly, the top 50 global LPs as a percentage of the overall capital deployed in Europe this year is going to fall for the first time in probably 8 or 9 years. And that capital is being replaced largely by private investors who are funneling smaller amounts of money, let's say $1 million, $5 million, $10 million into feeder vehicles that are usually sponsored by investment banks. And then those banks are then going and creating large open-ended core vehicles or committing that capital into direct deals. And because we have much more private capital that is less price sensitive, less interest rate sensitive, less cap rate sensitive, you see at the margin people not so much focusing on what the going in yield is today, which is rather low, but where the yield can be stabilized over a long period of time.